honestly doesn't care. It's not her problem. You chose to get divorced. This is the consequence of that divorce. And so now they're like, okay, well, now I've got to sell my home and now I've got to then go and rent.
Yeah.
Then how am I ever supposed to get a mortgage? Because sometimes I've had people that are renting, they didn't own a home.
Hi, my name is Sydney Mitchell.
Hi, I'm Matthew Brickman, Florida Supreme Court mediator. Welcome to the MediateThis podcast, where we discuss everything mediation and conflict resolution.
All right, so today I am joined by not only the professional, one and only Ryan Brown, but one of my closest friends that I've known, gosh, it's like my early 20s, and I'm 51 now. So, I mean, we've sort of grown up together, right, Ryan?
That's right.
I mean, it's been many, many, many years. But Ryan Brown, he's the branch manager, divisional vice president in Palm Beach Gardens of Cross Country Mortgage. What else? I mean, other than that, what other titles would you give yourself, or how would you describe yourself?
I would just say that we're a direct mortgage lender.
Okay.
Cross Country Mortgage is the largest retail lender in the nation. I operate this office in Palm Beach Gardens and a small office in Stuart, Florida as well. But we have the great privilege of helping people buy and refinance homes.
And you all right, and you've won like awards like year after year. Like you're it's almost like you're the only one. So what accolades and awards do you keep winning over and over again?
Well, we have an amazing team. We have won the best lender in Palm Beach County and also in the Treasure Coast for the last 3 years in a row, which is a great honor. It's more of a customer service award because your realtors and your builders and your clients vote for you. So it's a great honor to have that. But our world revolves around that client experience and getting people into homes. We help about 300 families get into homes per year. And I've helped probably over 4,000 or 5,000 people get into homes over my career.
Yeah. Well, you helped me get into the only two homes I've ever owned. So, when many years ago when I bought my condo, I was like, I don't know who to call. I'm like, I'm calling Ryan. And you were actually, you did my mortgage and then you even did my refi, which was awesome. And then on my current home, I bought it with, and you were with Cross Country, and I'll tell you, you guys were just fast, efficient. I mean, for my wife and I, and it was an odd experience. This was in 2021. We found the home on Sunday. Or no, yes, Sunday. We looked at the home on Sunday. We put an offer on Monday. The owners accepted it on Tuesday. We had an inspection on Wednesday. We had then but then prior to that, let me back up. Actually, let me get the timeline done. I called you on Friday because my wife said on Thursday, I wonder if we could get a home. We're like, well, where do we want to be? So we put our parameters. And I called you. I said, hey, Ryan, what could I qualify for? And you're like, Matthew, I need these documents, these documents, these documents. Now I'm a little meticulous and anal, and I got you all the documents that day. You were like, wow. Like it wasn't like I had to go find them. And you came back that day and said, okay, this is what I can pre-qualify you for. So then my wife and
Yeah.
I knew come Saturday, all right, we know we can pre-qualify for. So I called a real estate agent that I had done her divorce. And I said, I need to find homes in this area within this price range. Go. Sunday, my wife found the home. We looked at it Sunday, put the offer in on Monday. They accepted it on Tuesday. We had the appraisal on Wednesday, had the inspection on Monday, and then you guys closed us 3 weeks later. I
Yeah.
mean, it was a fast process. Now, granted, I had every single document like boom, 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 but your people were amazing. They were fast, efficient, um, loved the experience. So, usually also, just like Who Wants to Be a Millionaire, you are my lifeline in mediation. Like I'm either calling you or texting you, like when
I
I
know
run
when you
into
call,
something.
you're probably in a mediation. Yeah.
Yeah, and I'm like, hey Ryan, like, can you help me on this? Answer this question. So I've got
Yeah.
some questions for my listeners, just common things that come up.
Yeah.
I've got 5 questions, and then you can dump truck everything else back on me. But let's just start with question number 1. So I run into a lot of times where a married couple, they're getting divorced, and they're both on the mortgage. One of them wants to
Yeah.
keep the home. And so it's like, all right, we need to get one of the people off the home because one of them wants to buy the other one out. So we're left with, what I understand, 2 options. We're either refinancing the mortgage so that we can remove someone,
Yeah.
or they're doing an assumption of the mortgage so they can assume it so they can still get the other person off. I
Yeah.
have only, and Ryan, I don't know if I ever told you this or whatnot. It was way back in my career. I've been doing this for 18 years. I ran into one mediation only. It was a Fannie Mae mortgage, and it was fine print that said in a divorce we can simply remove. They didn't have to refi or assume. They just had to present a divorce decree, and they removed them. I've never ever had it other than that one mediation. It was like the unicorn of all
Yeah.
unicorns, right? Usually it's refi or assumption. So talk to me about like the differences, the process, requirements, timelines, because those are the things that my listeners need to know. And also, for me, when we're building these things out in mediation and draft, and we've got to
Yeah.
build out the processes. And I want to make sure that we're getting those timelines right. So we're not saying, hey, you've got to do it within 30, and you're going, Matthew, it takes at least 60 or 45, right? So talk to me about the difference there.
Yeah, absolutely. I mean, there's a lot of nuance there. So the best thing is really to determine what kind of mortgage do they have now. Is it Fannie Mae? Is it FHA? Is it a VA loan? Is it a private mortgage? And also determine what the current terms are and how does that compare to current market rates. So, for example, let's just say you have a 3% mortgage because you got it back in 2021 or 2022, and current rates are at say 6.5. So of course you want to try to keep those original terms. So in that case, you should always try to go for an assumption first, because an assumption doesn't change the terms of the loan. Now, in the case where let's just say you bought maybe a year and a half or 2 years ago and your rate was 7.5 or 7 7/8, you might want to just refinance to get a lower
Sure.
rate anyways.
Sure.
Because
Makes sense.
you could refinance, remove the person from the title and from the note, and then get it better terms. So you kind of have to determine the baseline first, and then from there, determine which option is going to be the best. Now, on the assumptions, so it's really servicer specific. So a servicer so Fannie Mae, FHA, the VA, they don't service loans, meaning they don't do any of the customer service portion of the loan. Like they don't collect payments, they don't have an online portal. So they have servicers service it for them. So technically it's up to the servicer to allow an assumption to go through. Most servicers are going to require, in a divorce situation, obviously proof of divorce, and they're also going to require that the one spouse, whoever's assuming the loan, can qualify for it.
Okay.
That's really where it can become a little bit of a problem, is if they cannot qualify for it, because you have to think about when they originally originated this loan, they used two sets of income, assets, etc., to qualify the loan. Now, if you remove one spouse and now you have, say, half of the income, maybe they're both breadwinners equally
Sure.
the same, you remove half, does this person still qualify to make that payment? And that's what they're going to try to determine, is that, can the person that's assuming the loan still make that payment and not put themselves at financial risk? And so that's what the servicer is going to do. That's why they don't just have a blanket, okay, yeah, you can assume it. Well,
Sure.
what happens if this person has $2,000 a month in income and the payment's $3,000 a month? That's just a recipe for disaster and foreclosure.
Sure.
Assumptions also do take a little bit of time too. Typically, I think the average is around 60 days for the
Okay.
process to go through. But kind of circling back, of course,
Is that minimum or average?
I would say average.
So, so for example, for me, what should I be putting in the agreement then? Should I put 90 days because 60 is minimum? Would 90,
I
like
would.
they'll definitely get it within 90,
Yeah,
right?
yeah, that's plenty of time. Either you're going to
Okay.
know it's going to go through or not
Okay.
within 90 days for sure.
Okay.
But if the assumption doesn't work, then at that point you would go in and try to do a refinance. Refinance again is the other way to do it. Same thing applies there, though. The person assuming that, or the person that's taking over the house is going to have to qualify for that payment. Now, in a refinance situation, there could be other things to consider as well. But maybe in that situation, maybe the current spouse assuming it can't afford it, or maybe they have income, but we can't use it for qualifying. You can also get a non-occupying co-signer. So maybe the mom or the dad or brother wants
I
to
run
kinda
into that. Yeah.
help
I run
out.
into that,
You could always add a co-signer on a refinance transaction to help them
but not on an assumption.
not on an assumption. Yeah.
Okay. Okay.
Um,
So, so, so when they're looking at the requirements, like not just the income, they're also looking at, because like in the divorce decree and in the settlement agreements that we're doing, we're not just dividing up the assets, we're dividing up the liabilities as well. So
yeah.
they're looking at income debt
Yes.
ratio, not just income. Are they looking at credit scores?
Yes.
Like what do they look at?
They're going to be looking at all that.
Oh,
Credit score,
okay.
liability, debt to income ratio, income. They're going to be reviewing all of that information
Okay.
and making sure the person can qualify. The other thing to consider too is that it's very important to have both parties, whoever's making the mortgage payment, to keep making the mortgage payment. If you have a
Yeah.
mortgage late, or sometimes you have a spouse in a divorce situation like, I'm not paying anything until we get this settled, and all of a sudden the credit just goes to crap. It's very important you keep paying it, because they're not going to allow an assumption on a defaulted mortgage or a mortgage that has
Oh.
had a late payment in the last 12 months. Most servicers will not allow an assumption in those circumstances. Same with a refinance. You can't refinance if you've had current mortgage lates or if you're currently delinquent on the loan. So in that case, if you have gone delinquent, you might be forced into a sale situation.
Yeah. So here's something that might blow your mind. That's interesting. I don't understand it, but there are things, I just put in that box of one day maybe I'll figure it out or understand. I don't understand it, right? But one of the largest counties in South Florida is Palm Beach County, right?
Mhm.
And a lot of my mediations, I mean, for 18 years, most of my mediations were Miami-Dade, Broward, Palm Beach, some Martin County, right? Of course, after 2020, it just blew up because everything went virtual. So now I'm all over the state and even the country, and I've done some worldwide stuff. But what's interesting is Palm Beach County is huge, right? And in a divorce situation, like Broward County, one of the things that is in a divorce order is what they call a standing status quo, which means, Ryan, if the husband has historically paid the mortgage, he cannot stop paying the mortgage. He has to, there's a like you
Right.
have to maintain the status quo during the pendency of divorce so you don't screw things up, right?
Right. Yep.
So they've got that like in Broward County. They've got that in all of Martin County, St. Lucie County, Indian River County, Okeechobee, all up in the 19th, right? Because you said you had an office up in Stuart, right? So in the 19th Judicial Circuit, they've got that. They don't have it in Palm Beach County. I don't understand how you can have Palm Beach County, one of the largest counties, and they don't have a standing status quo order. And and plus, that's also like the homes are usually worth more in Palm Beach County than Martin County or even Miami-Dade or Broward, right? There's no standing status quo. So I see that a lot, that either one of two things happen. Well, maybe a couple of things. And I don't even just put two. One of a couple things. Sometimes it's out of spite. right?
Yeah, for
Which
sure.
just ruins everybody. I mean, divorce is hard enough, but it ruins everybody. The other thing is sometimes because of the divorce situation, either one spouse has left the marital home by choice, or sometimes they've been forced by court order if there's domestic violence, or sometimes they're just like, look, this has been going on so long, it's just unhealthy. I need to get out for my own mental sanity. But then they move out and they
Yeah.
take on a rent, and then they can't afford the mortgage, right? And they're like, well, if you're going to stay there, you pay it. Well, like you said, I only make 2,000. The mortgage is 3. How do I do this? And the mortgage company isn't accepting a partial payment and going, well, that'll be
No.
fine, right? So there's a number of situations that can cause then the default. And if there's not a standing status quo order, what I'm hearing, because I didn't know that, because a lot of times they're like, yeah, we're going to try to refi or assume, and there's delinquency, there's
Yep.
problems. Someone has stopped paying for whatever reason, and they think we're going to go in and refi and assume.
Right.
And I didn't know that. So all right, well, what about this? Because I run into this sometimes where they've, what do they call it? Like when they, uh, I guess I'll just describe it. They end up putting it on the back end of the mortgage. Like maybe they were
Like a loan
delinquent.
modification.
Loan, yes, yeah, a loan mod to where then, okay, fine, they're not paying. Does that affect a refi or assumption, or is that sort of we change the terms and that's okay, and then you can still refi and assume? How does that play in?
Yeah, so loan modifications are typically, yeah, when you're in financial hardship, behind a few payments, you can call the servicer and request a modification or uh, basically they're trying to help you so you don't foreclose. So in that
Right.
case, sometimes they'll add a couple payments to the end of the mortgage. They will maybe lower the payments temporarily. They'll provide a 40-year term. There's different
Yeah.
options to provide help. So in that
Okay.
case, when you apply for a modification, you have to show some form of hardship. You have to prove it with your income documentation that there has been some changes. I'm not sure if within a modification they would allow an assumption as well. That's a good question. I don't know if they would do that. I don't think they would.
Well, based on what you're saying, just if you just logically play it out, I'm thinking they wouldn't, because how did you get into a loan mod? You were behind, you were
Yeah.
delinquent, and that dings you on a refi or assumption in the first place, right?
Yeah.
I mean, you just sort of kind of be like, well, if they look at that, they don't like that. You did that. Now we loan modded it. Are we going to now refi or assume it? And
Yeah.
usually in that case, you can't afford it. We're selling it.
Right. Yeah, a lot of times, like, there's a big emotional attachment to the property. They don't want
Oh
to
my
let it go, but
gosh,
at the end of the
yes.
day, they just cannot afford it. But
Yeah.
it's important to note that, yeah, like if there is current delinquencies, this is a great question in mediation. Is the mortgage current? Has there been any late payments the last 12 months?
Yeah.
Because if that's the case, if you write in the terms of their negotiated settlement, this has to be done within 90 days, like, well, that's not going to happen. So either that term has to be longer so they have time to take care of say the refinance or assumption, or something else has to be modified within that settlement, because if it's currently delinquent, you're not going to be able to assume or refinance it regardless.
Well, and usually what we do, because people are not sitting around waiting and waiting and waiting for this to happen, especially when we're usually talking, Ryan, about their largest marital asset, right?
Yep.
And so what we put in there, and what we're always negotiating, is that timeline. And we say, look, you have to close within X amount of days or it triggers a sale.
Yep.
That way it's not just sitting, because otherwise they will sit there, play those games, and then
Forever.
what happens is then, oh well, no, I wasn't able to. Well, then someone stops paying, then you get into that whole problem, and then everyone is losing.
Yeah.
But then they're dragging out then the foreclosure, and then the other one's like, you're ruining my credit. And so a lot of times, I mean, so as a mediator, I always put a if this then that scenario. I play everything out in mediation like it's an Excel spreadsheet. If this then what? If this
Yeah.
then that, right? Which is how you set up all your formulas. So And then I put, they're either going to, and I put refi/assume. I'll give you whatever option is necessary. Try your assumption. If that doesn't work, refi, whatever. Here's your timeline. And if neither of those work, then it gets sold.
Another thing to note on the timeline piece of it, if let's just say that the spouse that is taking over the house, they are going to be getting like alimony and child support, and that's
Right.
going to be their primary source of income. In order for a lender to use that as effective income, you have to be receiving it for 6 months minimum, documented receipt for 6 months. So
For
if
6 months before you will approve,
Before
or you
you-
have to have it on paper that you're getting it.
you have had to receive it for 6 months before we can close on a loan for you to use that as effective income.
But that's
so
so it'd be like 6, 7, it'd be like, so we would have to put like 9 months, sort of, kind of, right? Like,
yeah, probably pad it a little bit. Yeah. Yep.
yeah, because they have to have that for 6. Then we have our 90 days.
Yep. And then on
Right.
top of that, you have to have a 3-year continuance. So
So it has to,
for example,
has to
like if
keep
if you
going.
wrote in there, okay, you're getting alimony for the next, say, 3 years, but then we have to wait 6 months to use it. Now we're 2.5 years, we can't use it anyway. So you would have to be receiving it for like 3.5 years, close on that 6-month mark. And then you're from the date of closing, you have to have a 3-year continuance. Otherwise, you can't use it as effective income.
Wow.
Same
Okay,
with
these are
child
things I
support.
didn't.
If the kid's aging, as a lender, we have to
Sure.
verify the ages. So say
Sure.
one of the kids are 16 years old, in 2 years, that's going away. So we can't even use that as effective income.
So do you require, I mean, I'm asking, like, let's say, for example, I send you somebody, right? Do you require them to give you their divorce decree, parenting plan, so you can see the child support, the alimony, the equitable
Every page.
distribution, all of that?
We need the full divorce decree and marital settlement agreement, all the pages.
Okay, another question for you, because we don't provide this to the court because we're not supposed to and we don't need to, right? But let's say, for example, that we've got a couple, and in the divorce agreement, it says that the husband's receiving his car and the wife's receiving her car, and the husband's responsible for his debts and the wife's responsible for her debts. And then, we do divide up the retirement accounts. Like, we go through all the different pieces, right? So
Yep.
on my end, in order to figure everything out, like who should have what under Florida law to create equity where everyone gets 50-50, right? I'm running a program called Family Law Software where I'm running an equitable distribution chart where I'm loading in all of their assets, all of their credit cards, all their values, everything, where then you get to see, okay, this is going into his column and her column, so you can see what they have. Then at the top, it says, okay, here's their total assets, their total debt, and then here's what they're both walking away with. Here's your equalization payment, like all of that, right? You would need that, right? It'd be really helpful, right?
Yeah, technically we just need the divorce decree and marital settlement agreement. That's what all
But
lenders.
those are the words, yeah. But
Yeah.
you're looking at the words, not looking at the numbers. But you would need the numbers,
Yeah, we need all the
right?
numbers. Yeah.
I mean, now, if you had that could expedite the process a little bit, right? I mean, sort of like when I gave you my documents, you had them, like, you were like, oh, okay, well, we can move this thing along.
Yeah.
Because one of the things that I started doing on the real estate agent side, so before they see you, when the listing agent is selling the property, we have a private mediated sale agreement where we've got price reductions and they have to accept offers within a certain percentage, and we name who's the real estate agent. They're both going to cooperate with reasonable requests. They're going to both
Yep.
pay any fees and whatnot. They're going to keep the home in show condition, like all the rules, right? And we put in there that this is going to be produced to the listing agent, so they know the rules, right?
Yeah.
But that does not get filed with the court. That just gets held by the parties in the event. So going back to the agreement, it may say that the husband has 90 days to refi or assume, or it's going to be sold in accordance with the terms of the private sale agreement, right? That gets held by the parties. Then in that, it says, you guys give this to your listing agent. I'm thinking now that that might be an extra document, the equitable distribution chart that I provide to the parties that are selling a home, because that could definitely help expedite on your end for looking for the refi or assumption, because you're going to see the child support guidelines worksheet, you're going to see
Yeah.
the alimony analysis, you're going to see then the equitable distribution. So that should help with those three
That'd be
pieces
very
you're
helpful.
telling me about.
Yeah.
Here's alimony, child support. Then you have the written terms of how long, like when's it start, how long, and then you get to see, okay, like income debt ratio, there you go. Here's their assets, here's their liabilities, here's what they got. They're both negative $20,000, like, right?
Yep.
You would get to see, okay, what are their incomes, taxes, net incomes? You get to see all that breakdown. I'm thinking that I might need to put something in my agreements that says that upon request, they'll provide those documents and I just give it to them from the beginning. And then they have those for you.
Yeah, it would definitely be helpful for sure.
Oh, that's good. All right. So anything else we need to know about refi versus assumption?
Refi versus assumption, no, the biggest thing is obviously the terms change on refi, they don't change on assumption. Under both cases, you're going to have to requalify for the most part. And then, you just got to make sure that, before you kind of go down that path, whoever's taking it over, you maybe have a mortgage lender take a look at their income, credit, make sure that even a refinance is going to work. Because if it's not, then it's a sales situation is going to be a better bet.
Yeah. And so remember, I told you we had about 5 questions. We sort of took 2 of them together, because one of my other questions was, when qualifying for a mortgage after a divorce, what would a mortgage company consider based on how they divided assets and liabilities? And we just talked about that, which was one of my other questions.
Yep.
So let me ask you this then. What if, let's just say hypothetically, that the wife wants to keep the home. So she's going to try to refi or assume. And let's say that she can do either or. I don't care.
Yeah.
But she needs to buy the husband out of his equity as well.
Right.
So now, not only does she need to refi or assume, but now she's got to take out a second mortgage to pay him his equity.
That's right.
Okay, do we need to now extend the timeline even more? Is that a whole nother process, or is that inside that process?
It'd be inside of it.
Okay, so it would be inside. So how does that work for, I mean, is the mortgage company looking at the same factors? Like,
Same factors. So on the refinance side of it, same factors. It's just considered, instead of a rate and term refinance, they consider it a cash out refinance. So sometimes the rate's just a little bit higher, depending on the credit score. And then typically in a cash out situation, you can take out, your loan amount can be up to about 80% of the value, less
Okay.
your first mortgage. So for example, if the house is $1 million, your new loan could be 800,000 less your current mortgage payoff, say it's 600, so you could have about 200,000 in cash. So
Okay.
in a general refinance cash out, you can go up to 80%. The other way to do it is if you have that low interest rate first, and either you assumed it or you refinanced it to a low interest rate first, or you're just keeping the mortgage the way it is. Another way you could get cash is either through a second mortgage or a home equity line of credit, and that's going in second position behind your first. Those typically you can go up to 90% if you can qualify. The rates on those are a little bit higher than conventional first mortgages, so you're probably somewhere in the 7s, 8s, or 9s on a second mortgage. But that'd be a way where you could pull cash out to give it to your spouse.
And current 7, 8, or 9, like in a
Right.
year or so, who knows what it could be, but current, it would be
Exactly.
about a 7, 8, 9. So for example, one party could refi and inside that refi, pull out the extra money and then just have one mortgage that
Yep.
refied, removed them, and got them the money. Or maybe they refi, and for whatever reason, maybe they would take out a home equity line of credit. I typically run into what I see is they assume so they can keep, say, for example, that 3%, not
Yeah.
refi and lose that to now 6 and pull out at 7 or 9,
Yeah.
right? That they want to assume, keep that at their low rate, and then just take out a home equity line of credit that smaller piece is at the higher amount.
Correct. Yeah, that would be the best strategy for sure.
Okay. Um, Downsides to that? I mean,
Not really. I mean, the difference of second mortgages, the home equity line of credits, they're variable where the rate's not fixed and they don't amortize, meaning the payment doesn't go down over time. They're just interest only. Versus fixed second mortgages, they amortize, and they usually have a little bit lower rate. So they would just want to make sure they do a consultation with their lender to find the best product that would fit their needs.
got it. Got it. Um, so let me ask you about this. So this is something new that I read that I don't know, I think it's Trump's housing secretary had posted, or I read or heard something. One of the problems that I was running into, I haven't heard it recently, so maybe this goes towards it, but you know, you've got a mortgage, say at $2,000, you sell the home, and you had a nice 5-bedroom home. You got it at a low interest rate, you bought low, it was awesome, marriage was amazing. Now you're getting divorced, you have to sell the home, and now you get to go rent a 2-bedroom for $3,000. Right? And so many people go, what am I supposed to do now? And my answer, and I mean, it sounds cold, but that is the court. Lady Justice is blindfolded. She's not emotional. She honestly doesn't care. It's not her problem. You chose to get divorced. This is the consequence of that divorce. And so now they're like, okay, well, now I've got to sell my home and now I've got to then go and rent.
Yeah.
Then how am I ever supposed to get a mortgage? Because sometimes I've had people that are renting, they didn't own a home, and then they're like, well, how am I going to qualify for a mortgage? So what I heard was rent payment history can be applied towards showing a mortgage company that one can qualify. So like, for example, if you're paying $2,500, it used to be in rent, it used to be like, well, no, you can't afford a mortgage of 2,000. You've got a $2,500 rent payment. Is that true? How does that work? What do you know about it?
Yeah, like that case is more along the lines of like adding it to, say, your credit report to like boost your credit scores. And so there are ways where you can now use your rent, your payment history on your rent to add it to your credit to help generate higher credit scores.
Okay.
Lenders, depending on the loan product, don't always look at your current rent. Like if you're paying your rent on time, there's some loan products that require it, to prove last 12 months of rent, no late payments. But your standard loans like your FHA and conventional, Fannie Mae, Freddie Mac, they don't require the rent payment history. But that would be more of a function of maybe post-divorce rebuilding credit, where your credit literally got destroyed. You've negotiated, paid off your collections or did some negotiated settlements on those. And you're rebuilding credit. That would be a great, function of that if you could get that rental history now added to your credit, because that would definitely boost the credit scores.
All right. So I'm going to ask you a question that just based on something you just said. So we're talking about credit. Sometimes in a divorce, they're looking at, okay, well, I think we just got to file bankruptcy, right?
Yep.
And sometimes they're like, no, 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 we're going to do a loan consolidation. Is one better than the other in a divorce to then set them up for success for purchase later? Or are they both equally bad? Like, what does a lender look at when they're coming out of a divorce and either filing bankruptcy or then going, okay, well, I got my debt and you got your debt, and I'm just going to do a loan. I'm going to do a loan consolidation. How does the lenders look at that, or what?
I mean, it's better to like negotiate the debts and pay them and close them, do like settled for less than full balance. Like it's better
Sure.
to do that and then try to work on maybe disputing them and trying to get them removed from your credit post. Or sometimes when you negotiate with them, you can request, be like, listen, I'll pay you the balance, or I'll give you a percentage, but in exchange for that, I want you to remove it from my credit report. And so maybe you can negotiate that. Certain creditors, you can
Okay.
negotiate that, and the collection agency will take that money and then remove it from credit. It doesn't always happen. I mean, a bankruptcy is it's a big hit. That stays in your credit for
Yeah.
10 years.
I did that when I was young, and it was a big hit. Yeah.
The nice thing about, if you're going to go into bankruptcy is if you have like just a ton of debt, obviously your income has changed. The Chapter 7, you can wipe it out. If your income is still there and you just can't afford it, then you can, do the other bankruptcies where it allows you to do a payment plan.
Sure.
But general rule
Which is better?
It's going
Which
to be
is
at
better,
least,
wiping it out or payment plan?
for
For then purchasing later, do they look
purchasing.
at it differently, or do they like bankruptcy is a bankruptcy?
There's different ways of looking at it, but like the general
Okay.
rule is you're going to be at least like 3 years post bankruptcy to buy a house.
Okay. All right. So at least 3 years. All right. That's good to know. Yeah. I shouldn't have done it when I did. I mean, I did it. I mean, you and I knew each other because I remember you were working on like credit repair or whatnot back in the day. I did. I paid $1,100 to bankrupt 21,000, and then it was on my credit forever. I was like, it was just such a bad move. But I was young. I was in my early 20s, married with 2 kids, barely surviving. It was like, should have waited bankrupt like 100. That would have been so much better. Right? But 20, that's like these days you can't even buy a car for 20. So what was I doing? But yeah, it definitely did hinder. Because I mean, I had to wait to even buy my condo when you helped me because of that. Yeah, I remember I had to wait a period of time. I think when I first approached you, you had pulled it. It's like, not yet.
I mean, a lot of times when we look at, somebody wants to buy a house, they come to us, want to buy a house, they're post divorce, and you pull their credit, and there's just tons and tons and tons and tons of debt. And they're like, look, that was from my divorce. That was my ex-wife or my ex-husband.
Right.
And unfortunately, it's still on your credit. It's still going to be there. Even a charge off, that's going to be in your credit for 7 years. Even though you have, say, a court order, even for example, on a mortgage, say the person went late on the mortgage, you have a court order that says, my spouse, they are 100% responsible for
They
it. I quit claimed
indemnify
off the
me.
deed, but they never refinance. So every month they're late, it's going against you. Now, as a lender, yes, we can use the court order to not technically count it against you, but it's still going to count against your credit score.
Sure.
So your score is going to be in the toilet, so to speak. But technically, we don't have to count it against you from an underwriting standpoint, but from a credit score, it's going to, definitely increase your interest rates and maybe hinder you from qualifying for a loan.
Yeah. Well, and I always say, because I learned from my own divorce, the court can't supersede the bank and the bank can't supersede the court. I mean, and so I can't say, oh, well, look, I have a court order. The bank's going to be like, oh, a court order? Great. Or I'm going to go to court and be like, well, the bank says. They're going to be like, oh, the bank? Okay, well, then, yeah, well, no. They can't supersede each other. And so that's why, the question that I ask people in mediation is, whose name is it in? It's a marital debt, but whose name is it in? All right, that's going in your column because I'm not going to say, oh, well, this is in his name and she says she's going to be responsible for it. Okay, fine. Well, what if she's not? He's going to take the credit hit. And the bank can't, and the court can't come in and say, no, you need to pay it. The bank's going to be like, you signed it, you're responsible for it. And so that's why, like in theory, like in that chart that I run, yes, it's going to do a 50-50 analysis, but I'm putting things as they are titled in the appropriate person's column because the bank can't supersede the court and the court can't supersede the bank.
Yep.
So, all right, so let me ask you this question then. So, valuing a home, and I know, you're not an appraiser, but you work with appraisers and you know the industry and whatnot. A lot of times in mediation, and I send out a letter when people schedule mediation. I sent out a letter, listen, okay, required documents. And one of the documents is a current appraisal of a marital home within the past 30 days. Like, I want a recent appraisal. Give me a value, especially if we're having to negotiate equitable distribution.
Yep.
Ryan, nobody reads. Attorneys, paralegals, the parties, nobody reads. I'm like, how do you not, like, this is the letter for your divorce to get ready for divorce, so you're not wasting $1,000 an hour between attorneys and mediators to then try to put a value on something like, well, I don't know. And now
Yeah.
you got to come back or whatever. So then a lot of times the attorneys are like, oh, well, Zillow has it appraised, or Redfin has it, or,
Yep.
Trulio, or whatever. From my understanding, those are based on like comps. That's not your value truly of your home or what the bank is going to value it.
Right.
Is it good to use it? Okay, not good. Like, I mean, I know that there's nothing better than your own individual appraisal.
Yeah.
But if you don't have it,
I would say like in neighborhoods where you're an HOA, it's cookie cutter, where their algorithm can say, okay, you have a 3-bedroom, 2-bath, 2,000 square feet, and then they can pull the comps within that neighborhood, 3-bedroom, 2-bath, 2,000 square feet, probably the same model, and they'll average out those comps and they'll give you kind of a valuation. Now that doesn't take into account like any upgrades
Sure.
inside or anything like outside that you have, or
Yeah.
your
or maybe
pools
lot size, like maybe you're a corner lot and the other one is stuck in between, two homes.
Yeah, there's a lot of nuance there. I think it's a good kind of gauge. Usually it's pretty close, but not all cases. And I would say like if you're saying like a Jupiter Farms or Loxahatchee, there's going to be a lot of variations there because
Sure.
everything is so different. But nothing beats just an appraisal. I mean, you can get like a good quality appraisal from a local appraiser for probably, $450, $400, $200 each. You guys can split it. It's
Yeah.
worth it. At least you have a third party, a non-interested third party valuing the property.
Yeah. Yeah. And that's, again, I always thought, but go get these prior, but a lot of times, for two reasons. Either they just haven't done it, or sometimes they're like, look, we don't have money to be throwing around like that. And
Right.
and
Yep.
and I say, hey, look, you know what? If this is your largest asset, you cannot not afford to not do it. Like,
Yep.
you need to do it. Now, there are times where the parties will be like, yeah, we pulled, we had a friend that, pulled
Yeah.
comps. Sometimes one of the parties is a real estate agent. Like, who is not a real estate? Raise your hand if you're not a real estate agent in Florida. This guy, but everybody else is like, everyone's, going to real estate class and everyone's a real estate agent, but and so they're pulling their own. Sometimes though the parties just say, hey, look, you know what? I think it's about 650. I think it's about 630. You know what? You want to just call it 640? Let's just call it 640 and be
Exactly.
done.
Yep.
Okay, fine. But that could be for equitable distribution. When they go in, and let's go back to our first one of refi or assume, the value that's going to be used is the bank appraisal for
Right.
the refi or the assumption,
Which is usually
right?
very different than a broker's price opinion than a realtor. When they're pricing out the house, they're pricing out as what they're going to list it for. An appraiser is going off of closed comparable comps. That's it. Closed comparable comps. So the values are usually going to be quite different what you're going to list for versus what you're going to appraise. So yeah, if it's a refinance situation, especially in a cash out, it's always good to have an appraisal for sure.
Yeah. Interesting. All right. So what else don't I know? What else do I, or what else do I
Yeah,
need to know?
I would say, another thing that's, very important to make sure people are consulting with their, CPAs is the whole capital gains, because if you're a married couple and if you've owned a primary home 2 out of the last 5 years, you're exempt up to $500,000 in capital gains.
Okay.
For example, if you bought a house for 500,000, it's now worth say 1.2 million, you're now going to have a gain of $700,000. So if you sell the property and you're still married, then you're exempt for 500,000 of that 700, from tax, about 20%. So the 200,000 would be the taxable portion. If you're single, that drops to 250. So if the sale goes through, say, past the divorce, and this would have to be a CPA question on how they would categorize it.
Right.
But you just want to make sure that if it's a sale situation, you're not going to be stuck with only being exempt of 250,000 of the capital gains versus the 500, because that could be a big tax hit. So just something to be like aware of and make sure people are consulting their CPAs at the time if it's going to be a sale situation.
All right. So in that private mediated terms of sale I was telling you about, one, speaking of, and I've got another one for you too, because I've got two sentences here. So one says, each party is entitled to receive 50% of the capital gains exemption. It's a marital piece of property. They each get 50%. That's what you're talking about, correct?
Yep.
And then the other one that I have is each party, or the parties will split the homestead portability exemption 50-50 as well. Can you talk about that a little bit?
Yeah, there's that too. Because the great thing in South Florida is that when you're a homestead property, you're capped. Your taxable basis is capped at 3% per year. So your value can't just keep increasing like your taxable value. The county or the city has to keep it at a low rate. So as a primary, it's 3% per year cap. On investment property, it's 10%. So like your taxes can go up much higher on investment property versus primary. But over time, the longer you live in that house, that 3% cap keeps your taxes low. That's why sometimes you'll look at a property like, wow, that guy's only paying $3,000 a month. His house is worth, $1.2 million. Like, how is that possible? Well, the guy's owned it for 30 years. He hasn't moved. He's been capped that whole time.
Wow.
So the difference between your taxable basis and the actual market value is your portability. So let's just say they're taxing you at 500 grand, but your market value of the property is 800,000. You now have this $300,000 that you can now port over to another property.
Okay.
To drop your taxes. So like the way you're writing in is great, where you can say port over 150 and then 150.
Right.
And I believe that has to be done within 2 years. I think you have a 2-year window to port that over, if I'm not mistaken.
So what you're saying is, let's say, for example, they got divorced today, right? They would have 2 years to buy something else to port that to.
To port it, yeah.
Otherwise, use it or lose it?
Yep.
Wow. Okay. Didn't know that either. All right. What else don't I know? Or what else do, you know what? What about, how does that work, say, on a second home? Let's say that they have their primary home here and they have a second home in another state. I just had this recently, and they were going, let's see, the wife got awarded the property in another state. The husband and the wife, I think, were selling the one here, but they're not, I mean, it's not going to turn out dollar for dollar with how all of that is working with a refi or assumption, the buyout, because they're both on the properties, because then you've got different taxes in different states and different rules. And
yeah,
and one of them right now, they're both living in Florida in the marital one, and the one that they've got in another state is rental as well.
Right.
It's what do they call that? Not a VRBO. It's the rental ones. I forgot what they call them. What do they call
It's
them?
like a short-term rental or a vacation stay. Yep.
Yeah. That's
And
like
then, and actually, let me correct myself. It is a 3-year timeline to transfer the benefits, not 2 years.
Oh, 3 years. Okay. All right. That's still good. So when someone's keeping rental property, selling marital property that's homesteaded, and we're trying to value these things, they sort of have different values because they're treated differently. Correct?
Yeah, especially like a short-term rental, like the valuation on those, you could really have 2 different types of valuation on that. You could have the the sales comparison approach, where you just value it based on other sales. Say it's a cabin in North Carolina, so it's other sales of cabins, similar square footage and bed bath count. And then you have like the business portion of it. It's like, okay, well, yeah, this one's, the neighbor sold for, $1 million. So maybe our value is $1 million, but hey, listen, I'm bringing in $800,000 a year of income because I have all these amenities. So really the value is a lot higher because it's now a business. It's an actual business.
Yeah.
So there's different ways of valuing it. You could value it as an actual business, or you could value it as a sales comparison approach. So if it's a very successful property, you're probably going to get a higher valuation on the business side of it. Yeah.
Wow. Wow. All right. What else do I need to know? Or what other knowledge do you have that we may need to know about when it comes to, property after a divorce?
I think we covered, I think we covered most of it. I think it's just making sure you have, good conversations with your mortgage lender, with your CPA, obviously with your attorney. I think mediation is 100% the best way to go, and makes a lot of sense because you can really sort things out, and just get on the same page. But it's really important to not assume anything, to always, make sure you're getting the appraisal or talking to a mortgage lender, getting pre-qualified. Even if you're not doing a transaction, let me just make sure I can actually qualify if I do this in 4 or 5 months from now. It's better to flush all that stuff out up front. That way everybody's on the same page and it averts disaster down the road.
Well, and one of the other things I was just thinking when you said that we run into when it comes to valuations, which I have a hard time subscribing to, because it's like, but we're not doing that. Is, let's say, for example, they're going to sell it, right? They're like, well, it's worth this, less closing cost, listing fees, all of this. So then you actually get this.
Right.
So if you're going to keep it and refinance it, we have to take all of those things into consideration. No,
that's right.
You don't take all of them. I mean, yeah, you're going to have a closing cost, but you're not going to have listing fees and realtor fees. And sometimes the attorneys will be like, well, we're just going to attribute all of this. It's like, well, no, they're two different processes that have two different sets of fees. So usually, Ryan, in a refi or assumption, whoever wants to keep the property is assuming those fees. We're not factoring that in. If they're selling it and they're each getting half of it, then they're each eating the fees.
Exactly.
Right? Does that make sense?
Mm-hmm.
I don't think I've ever had one where it's like somebody wanted to keep the property, refi or assume, and they said, well, yeah, you're going to pay half of the closing costs. I'm like, it's your property. You're going to take it. If you can get over those hurdles, you can keep it.
Yeah.
So real quick, just to clarify, assumption. Can you assume a V? So I mean, I know you can assume. All right. Okay, I think I know. I think I know you can assume an FHA, right? FHA are assumable.
Yeah.
Okay. VA.
VAs are assumable, even to a non-veteran spouse.
Oh, I didn't know that. Okay, that's good. So let's say that husband served, he's got the VA loan, wife wants to keep the home, she can assume it because it's VA, even though she never served.
Right. Yeah.
And a lot of times he's like, look, we have to sell it, assume it, refund. I need that back. Right. Like it's attached to him.
Right. So the downside to the VA assumption is, so let's just say your ex-spouse assumes that loan, you don't get your entitlement back. Your entitlement is what you can use to get another VA. So the entitlement will stay with that property until she either sells it or
refinances. Yeah.
So a lot of times on VA, they don't want to do the assumption unless the guy's older or girl's older. They're like, I'm never going to buy a house again or something, and they don't need it. Then, but usually they'll want to have it refinanced.
Yeah, because I always hear, I want it back so I can go get another one. Conventional.
Yeah, you can assume
Assume.
conventional, same thing. The servicer has to make sure that you
They have
qualify.
to approve it.
Yeah.
And then you had mentioned in the beginning there was the the different types. I think you said private. Did you say
Yeah,
private?
sometimes you might have a portfolio loan or a private loan with a private lender or just a bank that keeps it on portfolio. And so all of those are just, you're going to have to just contact them to
You
find out
just
what
got to
their rules
contact.
are.
So, and these are the things that I tell people. Good, like if you know you have a home, you know that somehow in one way or another, refi, assume, or sell, you have to remove the other person. You're going to need to buy them out. Go have these conversations before mediation so you can come and have an actual intelligent conversation where we can simply then just map it out. But so many times they don't, which is why you get phone calls from me. Asking just general questions. And of course, you're like, have them come in, we'll sit down, we'll take a look at everything. Because I mean, just getting a few like pieces, you can't say a definitive yes or no, because then they could present something that's like, oh, well, it was yes until you told me that,
Yep.
right? So if they're going to come in, let's just say that they're going to come in and talk to you prior to see like maybe that they may pre-qualify for something or whatnot. Like, is it sort of like CarMax where it's like, hey, yeah, here's your offer. It's good for 90 days. Like if they
Yeah.
pre-qualified, how long is that good for?
Typically 60 days. And then you
Okay.
just have to update it, with a quick conversation.
And again, just to pre-qualify, you're looking at the same things. You're looking at their credit score, their income debt ratio,
Yep.
whatnot. And then what about like a stay-at-home mom or dad, or maybe they're unemployed or whatnot, and now they're going to have to try to do something. They need to show income for how long? I know we had talked about like alimony or child support. Is it the same thing like income is income? They need to show 6 months income?
For the most part, yes.
Yeah, 6 months income. And only because I keep running into this too. What if they had a job and then they lost a job and then they got another job and then maybe they lost that job or quit it and they got another job? Is it 6 months continual, the same?
If
Or
you've
is it,
been,
I mean, if they keep bouncing, I mean, to me, I'm going, gosh, something's
yeah,
wrong if
underwriters
they
want to
can't
see
hold down a job.
stability for sure.
Yeah.
On FHA, if you've been out of work for greater than 6 months, they want to see 6 months back to work. Conventional is,
Okay.
conventional is more, loose on those type of guidelines where, maybe you've been a stay-at-home mom. You have to have at least a 2-year work history. So let's just say maybe 2 years ago, you're a full-time executive. You took 2 years off, been raising the kids, but now you just got an offer to go work for Johnson & Johnson at 100 grand a year. We have an offer letter. We could use that and she could qualify on a conventional loan. FHA
Okay.
has the rule of the 6-month rule. If you've been out for 6 months, you got to be back to 6 months. Conventional, it just has to make sense. And we still have to have a 2-year history. So prior to your time off, we got to have a history kind of going back 2 years.
All good information. Because I'll tell you, now I'm a bit apprehensive talking to anybody. I've been doing this for 18 years. I've done over 3,400 mediations. I have mediated over 12,000 hours. And now I'm going, yeah, I don't think I want to deal with a house until they go talk to Ryan Brown. Because there's a lot that I'm setting up the rules, but I didn't even know the court versus the bank, me court side, you bank side. And unless those two were talking and exchanging documents and getting a full picture, I don't want to set people up going, yeah, you can keep your home. Yeah, I get to keep my home. They come and see you like, nope, you can't keep your home. Vendor
Right.
said I can keep my home. The judge said I can keep my home. Sorry, you can't keep your home. We can't do it within these timelines. You haven't shown this. No, you can't do that. So
Right.
like, I almost don't want to even touch anyone with a home in mediation until they've got this information. Because
Yeah.
really, I could be setting them up for failure. And that's not the point of mediation. The point is
Yeah.
empower you so you can achieve whatever goal you want. But what I hear from you is the people really need to do their own investigatory work. Don't put your head in the sand. Don't ignore it. Don't be weak and cowardice. If you want this house, you better step up and figure it out before you ever land in mediation. Right?
Yep. Yeah, it'd be
All
much
right.
easier negotiating if you walk in and say, "Hey, listen, oh, by the way, here's my pre-approval letter. I'm good for the 500,000."
Absolutely. Absolutely. Here's the value. I mean, pulling
Yeah.
a statement to see what you know, that's easy. They log on, here's my statement. That's easy. It's usually the value to figure out the equity, to figure out the equitable distribution and all the other stuff.
Yep.
So, all right. So, we got two things left before I say goodbye. First, what is the best way to find you? How can people get a hold of you?
Yeah, best way, just the website is it's just Ryan D, as in David Brown, RyanDBrown.com. Has all my information there. Or you can email me at ryan.brown@ccm, Cross Country Mortgage, ccm.com.
All right. And phone number? They want to call you?
Yeah, 561-253-1807.
And your home address if they want to stop by and drop you off a present now. All right. So, all right. I always ask my guests now, lightning round, 5 questions. Okay. All right. And I say lightning, and then it turns into this long conversation because you have to explain it, right? But dream job, what is it, or what would it be? Or are you doing it?
A dream job?
Dream job. Yeah.
Working for Dana White at the UFC.
Doing
Anything.
anything. So working. All right. That's interesting because tell everybody why. You have a little bit of background in UFC.
Yeah. No, I've been training like my whole life: wrestling, jiu-jitsu, Muay Thai fighting. I've had a few fights, so yeah, it's good. It's good stuff. I love it.
All right. So if you want your mortgage, Ryan will actually fight to
That's
get
right.
it for you. You will fight to put Ryan in the cage. He will fight to the death to get you your refi assumption or your home equity loan. All right, number 2. Favorite type of music?
Favorite type of music is probably Christian, and my kids have
Okay.
me all into like Josiah Queen and Forrest Frank lately, so that's what they listen to. So that's what I listen to.
All righty. Favorite food?
Favorite food? I'd probably go Thai food.
Thai food. Okay.
Salty, sweet, spicy, and sour all at the same time.
you just hit all the notes. All right. Well, speaking of food, if you could have a meal with one person, living or dead, who would it be and why?
That would 100% be my grandfather. I was very close with him. He died at the age of 105, and
105? I didn't even know that.
he was a great man. So
Wow.
I'd love to have one dinner with Grandpa Brown back for sure.
All right. And why?
Oh, he's just an amazing person. I've always learned so much from him. And just have that time back. Time. It's just those things that you can't get back. So you have to enjoy every
Yeah.
moment.
Yeah. So, all right. So I'll tell a little story. Speaking that you mentioned Grandpa Brown, so you told me something when we were very, very, very young that I still remember this day, and I even tell people. But it was something that you told me that Grandpa Brown told you. Okay. Do you remember what it was?
No.
But okay. You told me that he said, when you look for a woman, there's 2 things you look for. Does this sound familiar?
Yep.
What did he tell you?
The two things. Well, one is the eyes, because they'll never change.
Eyes. Yeah.
Yep.
Window to the soul. And number 2?
Number 2 was a sense of humor, probably.
All right. You told me conversation.
Conversation. Yeah.
You told me conversation because one day may come and there's nothing else that can happen between the 2 of you, and you better be able to communicate.
Yep.
So the eyes, window of the soul, and communication. I've always remembered that. I've taken it with me. And even when I found my wife, when I found Mary, eyes, the window of the soul, and we have always been able to communicate. Granted, most of it is arguments because we're both opinionated, strong-willed, and excellent communicators, but she's my best friend to talk to. And I've always remembered that, like, oh, so Grandpa Brown. And I remember you said, that was what he said. Okay, last question. All right, so that makes sense. Last question. If you could live anywhere in the world with your family, so you're taking your kids and your wife with you. If you could live anywhere in the world with your family, where would you live and why?
I mean, I love America, but if it was outside of America,
Yeah.
it would definitely be in northern Italy. My wife's family's from there. We've spent a lot of time up there. It's just the most beautiful, small little towns, amazing food. It's just great. Northern Italy would be the spot.
Northern Italy. Anywhere like particular, like city, town? I'm unfamiliar with Northern Italy. So you
Like
could be
anywhere in
like,
the Alps or the Dolomite
Okay.
mountain range, like anywhere up in the mountains, a little valley town
Awesome.
somewhere. Be great.
so you go from the beaches of Florida to the mountains of Northern Italy.
Yeah.
That's awesome. Well, Ryan, I greatly, greatly, greatly appreciate your wisdom, insight. And as always, I'm going to continue referring people to you because there is no one better. People have tried, but you're the one with the awards. So there's no one better. So I appreciate you.
Absolutely. Matthew, it was a great honor. Thank you for having me on. You're a great friend, and just big respect for you for everything that you've accomplished in the mediation industry. And, just very proud to see like where you've grown in your career. So congrats to you. Kudos.
I feel the same about you. So thank you so much.
All right, Matthew. See you.
All right.
Bye.
For more information about my services or to schedule your mediation with me, either in person or using my iChat mediation virtual platform built by Cisco Communications, visit me online at iMediateinc.com. Call me at 561-262-9121, toll free at 877-822-1479, or email me at mbrickman@iChatmediation.com.